Since China's growth has slowed dramatically over the past years, many analysts are questioning whether or not China will ever overtake the United States as the world's largest economy.
China's official economic growth target. Chinese economy to grow 2.8% this year. The government seeks to jumpstart the world's second-largest economy.
Many experts believe that by the end of the decade, China's GDP in US dollars would have surpassed that of the United States, culminating in what is widely regarded as the most remarkable economic rise in history. But Beijing-led initiatives, like its zero tolerance for COVID-19 efforts to regulate down real estate speculation, have drained growth and lowered expectations for China's economy in the coming years. Economists have grown increasingly pessimistic about China's long-term prospects as they reduce their projections. Unfavorable demographics and excessive debt levels might dampen any revival, they say. Here's why China won't overtake the US as planned. Economic growth. China's economy will need to grow by about 5% each year as Xi Jinping begins his third term in office and works to achieve his aim of making China a middle-income developed nation within the next decade. Yet, terrible demographics, high levels of debt, and slowing productivity development indicate that the country's true growth potential is closer to half that amount. Beijing, like the rest of the world, has not yet fully processed what a 2.5% growth rate in China means. One reason is that even if China's GDP grew at the same rate as the United States, which is 1.5%, and if inflation and the exchange rate stayed the same, China wouldn't become the world's largest economy until 2060, if ever. The X factor: age. While many economists are optimistic about China's economy, they are ignoring a significant demographic factor. The fact that China has an aging population is a factor that can drastically alter the outcome of any calculation. In 2050, the median age in China is expected to be 56, while in the United States, it will be 44. Traditionally, economies with younger median ages have been more dynamic and creative. Economic growth could slow significantly if the median age and the percentage of the population over 65 both continue to rise. As a result of its transition into the middle-income bracket, China's economy is likely to see some slowdown. The current per capita income is $12,500, which is 1/5 of the US average. These 38 advanced economies all passed the $12,500 income threshold in the decades following World War II, with the majority of them doing so in very slow increments. Just 19 expanded at a rate of 2.5% or more over the next decade, and they did so with the help of an increasing labor force. The working-age population rose at a rate of 1.2% per year, on average. Two only had a decline in their labor force, and those were Lithuania and Latvia. In this group, China stands alone. The country would make history if it managed to keep its GDP growing at 2.5%, despite a drop in the working-age population that began in 2015. And this reduction is particularly severe in China, where the economy is expected to shrink by roughly 0.5% per year over the next few decades. In fact, China's GDP growth has slowed from 9.5% in 2011 to 8.4% in 2021 and 3% in 2022. Without a doubt, the protracted trade war has hampered economic activity by lowering consumer confidence and so dampening spending. Once again, the aging of China's population is a major factor. Long-term expansion requires more people to use more capital efficiently. Despite a falling birth rate and stagnating productivity, China has been expanding at an unsustainable rate by pumping more money into the economy. Debt. There's a monetary obligation in China. Debt, including government, individuals, and enterprises, averaged 170% of GDP in the 19 countries that maintained 2.5% growth after reaching China's present income level. None has debt levels even close to those of China. China's debts were stable at around 150% of GDP prior to the 2008 financial crisis. But after the country began pumping out credit to support growth, they skyrocketed to 220% of GDP by 2015. The Chinese economy slowed in the 2010s, as is typical after a period of excessive borrowing, although by a smaller margin than one might expect given historical precedent. The current level of debt is equivalent to almost 275% of GDP, and a lot of it was used to finance boom-era real estate investment. A tech industry surge, and more critically, increased debt issuance, saved China from an even more severe economic downturn. The country's total debt has risen to a whopping 275% of GDP, much of which was used to finance investments in the speculative real estate market during the bubble. Capital investment, especially in real estate, boosted GDP growth last decade, but productivity growth slowed to a mere 0.7%. Local government debt is a particularly pressing issue across the country. Over a third of China's GDP came from the real estate business. But the debt explosion caused by the China Evergrande Group's bankruptcy may eventually harm local governments, which have traditionally balanced their budgets by selling land to real estate developers. This is no longer possible at this time. Governments at all levels will experience a gradual decline in their financial stability, and the existing regional divide will only widen. The conflict between the affluent coastal area and the less so in the western region may boil over and spark a pebble if it becomes public knowledge. The Chinese government has set some primary policy goals: economic growth of 5% per year and debt reduction. Concerns are that austerity measures enacted for the sake of debt reduction and stabilization will induce economic stagnation. GDP growth ratio. Capital efficiency plummeted. China now has to spend $8 to make $1 in GDP growth, which is twice as much as a decade ago, and the worst of any major economy. An increase of 2.5% would be considered successful at this time. A basic productivity increase of 0.7% per year is just enough to counteract the drop in population. China would need capital growth rates similar to the 2010s to achieve 5% GDP growth. Housing, roads, and bridges ate up the bulk of that funding. In light of the severity of the housing market collapse, annualized capital growth is expected to decline to around 2.5%. Yuan depreciation. The general agreement is that China can reach whatever goal it sets for itself, but recent years, when growth is expected to slip below 3%, have seen consensus estimates fail to account for China's rapid deceleration. At the turn of the century, many respected economists predicted that China's GDP will surpass the United States by 2020. Some economists previously declared China to be the world's largest economy in 2014, using the meaningless concept of purchasing power parity, PPP, to justify their claims. It was theorized that the yuan was significantly undervalued relative to the dollar, and so would eventually rise in value. China's currency depreciated instead, and its economy is still a third smaller than the United States in nominal terms. If anything, a growth rate of 2.5% is an optimistic projection that downplays the threats to growth, such as rising tensions between China and its main trading partners, increased government meddling in the most productive private sector, technology, and rising debt worries. The ramifications of China's economic, political, and military superpower aspirations at a growth rate of 2.5% are enormous. It's more likely that China will become weaker than people realize. Inequality. China's economy is being stymied by a number of problems, including inequality. This latter issue is indeed problematic, but the fact that China is resorting to coercion to address the problem of inequality is far more so. The drive towards shared prosperity would eventually derail China's economic progress because it will harm the competitiveness of Chinese businesses. Chinese private companies are quickly going public and falling under government regulation. Despite the government's hopes, a more cautious approach to capitalism may reduce China's entrepreneurial spirit and reduce the country's competitive edge. While the strategy can help new companies flourish, it will have a chilling effect on others that require originality and risk-taking to thrive. The primary root of inequality in China is the country's governing system, and while China is seeking to restructure its economic and financial institutions without upsetting its society, it is uncertain whether this can be done without any changes being made to the governing system. Xi Jinping, the current leader of China, is tasked with achieving growth and equality, two objectives that seem diametrically opposed to one another. The road to these goals is arduous, and inequality in China is getting worse. Taking all of this into account, the idea that China can beat the United States in this competition is pure fantasy. If China wants to gain ground in its rivalry with the North American superpower, the aforementioned flaws must be fixed. It's debatable if the current Chinese government has the wherewithal to help the country overcome these obstacles. That's all for today, guys. If you liked this video, be sure to leave a thumbs up, subscribe to the channel, and press the bell icon for any new updates. See you in the next one.